Is China's banking system about to go bankrupt? We've seen many concerning reports come out of the socialist state recently, leading to a potential question regarding a financial collapse in the second largest economy in the world. China has been hit with record inflation, a collapsing currency, record unemployment, and a major banking crisis. This video will unpack exactly what is going on in the second largest economy in the world. The banking system has been hit hard with its largest lenders cutting loan rates, while bad debt is piling up amid a property crisis. Traders are bracing for more pushback from China's central bank as the yuan approaches the lowest level in 14 years. The onshore yuan has lost about 4% over the past month, trading within 1% of 7.2 per dollar, a level it hasn't reached since 2008. More betting against the yuan has been a successful strategy this year, as the currency fell 11%. It's on pace for the biggest annual decline since 1994. The banking industry's outstanding non-performing loans rose to a record 2.95 trillion yuan as of June. The lender's exposure to real estate is bigger than that of any other industry, with 39 trillion yuan in outstanding mortgages and 12 trillion yuan in loans to developers. Official data shows, in particular, Bank of China's exposure to mainland property is higher than its peers, at about 38% of total loans. Banks will face even more margin pressure in the second half of the year as the impact of lower benchmark rates emerge. 5 of China's largest banks are showing their wounds from this ongoing property sector crisis, with bad debts linked to real estate surging in the first half of the year, even as they posted modest profits against the backdrop of an economic slowdown. China Construction Bank and Bank of China reported a 68% and 20% increase in bad real estate debt in the first half of the year. Meanwhile, the world's largest commercial lender by assets, Industrial and Commercial Bank of China, reported a 15% increase in real estate sector sour debt over the same period. Vice President Wang Jingwu recently stated that affected by the epidemic and the downward pressure on the economy, the current operating environment of banks is complex and grim. That kind of admission from a central figure in the Chinese banking system sounds alarms across the whole sector. Even the CCB president stated that the Chinese economy faces fairly large downward pressure this year. These major banks are a number of many which have reported growing bad debt in the real estate sector, amid a grim first half in which rising developer defaults halted housing projects, leading to mortgage boycotts across the whole country. Mortgage defaults don't only create major social problems across society, but also a potential financial stability issue, as a mortgage is usually a good quality asset for banks. At Chinese Construction Bank, overdue mortgages caused by the boycotts hit 1.14 billion yuan at the end of July this year. Of course, regional banks are hit hard with these challenges. In April this year, we saw major bank runs in rural China. As many as 400,000 banking customers across China were unable to access their savings. China's banking sector has increased 6 times since 2008, with total assets reaching over 50 trillion, according to government statistics. However, the funding structure of small lenders also makes them more risky compared with big banks, as they are more reliant on deposits for funding. Many of them offer high interest rates to attract commercial and interbank deposits, but also the slowing economy means borrowers struggle to repay the banks. It becomes difficult for them to deliver returns they offered savers. Property was the asset that benefited the most from China's rapid credit expansion over the past decade. Developers are currently facing a collapse in the property sales. Developers' total annual residential housing sales revenues reached a peak of 18 trillion yuan in June 2021, but now have declined to only 13.2 trillion yuan over the past 12 months, a loss of 4.8 trillion yuan, or around a staggering 4.5% of GDP. Sales of completed houses this year are actually unchanged. However, as you can see with this graph, the only sales of pre-construction houses have declined significantly. Nowhere is the stress from the property sector more apparent than local government finances. Local government financing vehicles were some of the primary borrowers from the shadow banking system, and many localities have already suffered from the deleveraging campaign and its impact on informal financing. Yet, given local governments' financial distress and declining land sales revenues, a bond default by local government financing vehicles is only a matter of time. One of the most concerning aspects of the Chinese economy is the closing of factories. China is a socialist market economy. When an economy that is largely dependent upon manufacturing closes its factories for any period of time, the economy severely suffers. Just as recently as August, China was forced to close factories to the biggest heat wave in 6 decades, which forced certain manufacturing regions of China to close to conserve electricity. Earlier this year, we've seen many supply issues as big factories in China have been forced to close due to COVID concerns. Even at the time of this video, millions of people and factories are being forced to close. Most recently, the city of Chengdu, which contains 21.4 million inhabitants, were in complete lockdown. A couple weeks ago, data showed that Chinese factory activity contracted for the first time in 3 months in August, amid weakening demand, while power shortages and fresh COVID-19 issues disrupted production. Nationwide, at least 74 cities have been in complete lockdown since late August, affecting more than 313 million residents. Goldman Sachs last week estimated that cities impacted by lockdowns account for a staggering 35% of GDP. China's steel production is falling. This year through August, it was down 5.7%. China is the largest producer of steel, so any decline will have widespread global ramifications. Retail sales worldwide are declining. This is severely impacting China. Early this year, the Chinese government targeted a 5.5% GDP growth. However, since the government has gone silent regarding forecasts, at this moment we're expecting growth to be closer to 3%. Export demand has been a consistent and important economic driving force for China's economy for the past couple years, but that support looks to be declining as concern about recession increases. South Korean exports, a leading indicator for global trade, contracted almost 9% in the first 20 days of September from a year earlier, only the second drop in almost 2 years and the biggest fall since July 2020. The cost of shipping goods from China has come down to the lowest level in more than 2 years as falling demand finally eases the congestion that had plagued global supply chains. This is a good thing for US consumers as it will help to bring down inflation in the US and elsewhere by lowering shipping costs. However, such drop will hurt Chinese companies. The short-term future looks bleak for China. The economy will continue to stall in the next few months, according to Raymond Yang, the chief Greater China economist for ANZ Research. Local governments will be more inclined to prioritizing zero COVID and snuffing out the virus outbreaks as the party congress approaches. Of course, the hardest hits are the Chinese citizens. China's job market has collapsed in the past few months. Most recently, data showed that the unemployment rate among 16 to 24-year-olds hit all-time high of 19.9% in July, the 4th consecutive month it had broken records. That means China now has about 21 million jobless youth in cities and towns. This doesn't even include rural unemployment. It's important to focus on China's economic struggles, as it will have worldwide ramifications. We all buy products from China, have jobs closely connected with China, and are indirectly impacted by its economic decline. This will hurt the whole world, and it's likely to get worse in the coming months.